Welcome to today's presentation. My name is Peter Yusuf, Senior Analyst at IronFX. In front of your screens, you have the US dollar index for our chart. All charts to be presented are to be of the same time frame. Now, with no time to waste, we note that the US dollar was retreating yesterday. It was very characteristic. We had a number of financial releases which tended to weigh on the greenback, starting with the second estimate of the US GDP rate, which showed that the US economy in the second quarter of the year practically grew, yet at a slower pace than what was initially calculated at the preliminary release. It dropped from 2.4 to 2.1%, quote unquote, on an annualized basis. I would be highlighting here also the drop, the wider than expected drop of the ADP employment figure, which highlighted or more or less intensified market expectations for a lower than expected NFP figure tomorrow. And those may have been key contributors to the weakening of the US dollar yesterday. However, surprisingly enough, I would be noting that the US dollar index rose during today's European session. That was something which was a little bit unexpected. We actually expected it, as it broke below the 103.15 support line, to move even lower, especially given Atlanta Fed President Bostic's comments that the Fed's monetary policy is already restrictive enough, which tended to imply that the Fed may remain on hold in its coming meeting. Yet traders had a different opinion and provided with some support for the USD, buying it and pushing the US dollar index once again higher than the S103.15, which more or less tends to imply that the sideways motion seems about to continue. And at this point, it would be interesting to note that the low point practically tends to imply on a technical level that the corridor within which the US dollar is moving may have a lower boundary, practically somewhere here. Note that it was met again here, second time here. So that forces us to widen the corridor of the current sideways motion, lowering the S1 to 102.95. For the time being, we tend to maintain a sideways motion bias. At this point, though, I would be also lowering the S2, bring it somewhere here. It's just a bit, I know, but still. At the 101.90, 30 pips lower, ticks, sorry. Let's have a second look at the, give me a sec to add the toolbars. Let's have a second look at the S3. Which I'm going to be lowering as well. No, I'm keeping that. I know it's a little bit asymmetric, but I don't care. 101.20 it is. Readjusting the chart. Okay, let's talk direction. Let's replace a little bit the support and resistance lines. Sorry, levels, labels. So we tend to maintain the bias for the sideways motion to continue between the R1 and the lowered S1 at 102.95 for the time being. Should the bulls take over, we may see the price action of the US dollar index rising, breaking above the R1 104.35 and start aiming for the R2 105.45. On the flip side, should the bears be in charge, we may see the index dropping once again, breaking this time the lowered S1 102.95 and start aiming, if not breaching, the 101.90. The RSI indicator has been on the rise, reflecting practically also the upward movement of the US dollar index. And it's currently aiming, nearing it, almost has reached the reading of 50, highlighting exactly that the bearish sentiment seems to be fading away. Okay, let's have a look at Euro USD, which should be in reversed, and it is. Now we have a drop of the Euro USD. Now the interesting part here is the following. We had financial releases, which were released practically yesterday in the European session. We talked about Germany's HICP rate as well as Spain's. Germany's HICP rates at the end for August was the preliminary rate, failed to slow down as much as the market expected. And in conjunction with an acceleration in the prices of France, allowed Eurozone's preliminary HICP rate for August to practically come in higher than expected. And that would be more or less an indication of a stubborn inflationary pressure within Eurozone's economy. Now, the releases as such may more or less force the ECB to actually hike rates. It was characteristic that the comments made by ECB board member Schnabel during today's earlier European session highlighted exactly the uncertainty of how much the ECB may be hiking. At the same time, we also note that in the late European session today, in about 2 hours, we will be getting also the monetary policy account of the ECB for the July meeting. And the document may also sound a little bit hawkish. Should that be the case, we may see the euro getting some support. For the time being, though, it's characteristic that the euro may have the biggest losses against the US dollar strengthening. So that's a bit of an issue. There was a nice upward movement on a technical level. Noted here. Note how it risen, had a peak, corrected a little bit lower, then once again second peak. Now we expected actually another contraction, a slow one, a shallow one, and then another jump higher, breaking the 1.0945 and start aiming for the 1.1035. That was not the case. Euro USD actually corrected lower and is currently testing the 1.0870. For the time being, we highlight the fact also that the RSI indicator has reached the reading of 50. It's actually right now at 51, implying that the bullish sentiment faded away. So our expectation now is initially for the pair to remain in a sideways motion, yet there is a strong chance also that the bears may take over, force the pair to break the S1 1.870 and start aiming for the 1.0765. On the flip side, should the bulls regain control over the pair, we may see Euro USD rising, breaking the R1 1.0945 and start aiming for the R2 1.1035. For the time being, that seems to be improbable, but it's still a possibility and it should be covered. Moving now to cable GBP USD. In a similar fashion, allow me, GBP USD was able to advance, yet is now correcting lower. For the time being, we will be correcting the former resistance line into support line. And let's go hunting for a new ultimate resistance level. Let's go a little bit further back. Okay, you can see the green line, which I've just set, once again is being verified by a number of movements, peaks. So that seems to be a valid point. In red. $131.40. But at this point, I would also like to recalibrate lower the S3. Let's narrow it. Somewhere here. It's more clear-cut true. And that would be at the 1.23. The wider corridor practically reflects also the high volatility of the pair. $1.2540, $1.2675, $1.2790, $1.2945, and the extreme bullish scenario, we see the 1.3140. Locking everything in. For the time being, given that the upward movement has been interrupted, that's pretty clear by the downward motion of today's European session and the strengthening of the US dollar, I would expect the pair to remain in a rather sideways motion, given that the RSI indicator has not reached the reading of 50 yet, but it's nearing it. Nevertheless, once again, like Euro USD, GBP USD has bearish tendencies, and I would expect it to break the S1 1.2675. Should the bears take over, I wouldn't be surprised to see it reaching the S2 1.2540 before moving lower. For the time being, though, once again, the S1 may be the catalyst behind the movement and practically allow the pair to remain in a sideways motion around it. Let's have a look at USD-JPY. USD-JPY maintains its sideways motion, that's pretty clear. No major fluctuations. There were some slight bearish tendencies, but the pair remains rather sideways. Just below the 146.60, the RSI indicator, despite dropping slightly below the reading of 50, remains pretty close at 47.1, more or less highlighting a rather uncertain market about the future direction of the pair. I would expect this uncertainty or indecisiveness to allow exactly the sideways motion to continue for now. And in that case, we may see it maintaining a steady course just below the 146.60 resistance line. Should the bulls take over, I would expect USDJPY to rise, break the 146.60. That would be also a signal that the upper boundary of the current sideways motion has been interrupted, and start aiming for the 149.40. On the flip side, should the bears take over, I would expect the pair to drop. I would require a lower true than this one for a bearish outlook, so the 144.60 support line has to be broken. And I would expect, should the bears take over, for the pair to start clearly aiming the 142.25 support level. Let's have a look at a pair which we haven't seen for a long time, and that would be USD-CHF. Zooming out. Let's move to the daily chart. Okay, there was an upward movement which seems to have been interrupted. We can see it here. And there is a relative stabilization right now, right here. So let's have a look at the 4-hour chart now. Definitely this level used to be a resistance line, now has to be turned into support line. Let's go hunting for a new ultimate support level, resistance level. And unlocking the chart. Okay, one could place the level here. I'm going all the way here. Seems good. So it's going to be in red. 0.9015. It's a little bit wide, but symmetry is not one of my main concerns once again. Now let's also place some labels, have better visualization. And we're starting with the R3. 0.9015. Second resistance line, R2 at 0.8915. Yep. First resistance line at 0.8850. Let's verify that. Moving now to the S1 at 0.8735. In green, please. Moving now to the second support line. Okay, we have a small mistake here. Give me a sec. That's 0.8785. Sorry, guys. Just allow me to correct that. And last but not least, the S3 being placed at 0.8655. So, let's talk direction. USDCHF was on the rise, yet the upward movement has been broken. That's clear. For the time being, the main body of the price action tends to remain between the R1 and the S1. So we tend to maintain a bias for sideways motion between the pre-mentioned levels. There could be a wider range. Yeah, I would be discussing it, a wider corridor. But I think the current boundaries seem to be sufficient. Should the pair actually be dominated by the bulls, we may see the price action rising, breaking the R1, 0.8850, and start aiming for the R2, 0.8915. On the flip side, should the bears take over, we may see the price action dropping, breaking the S1, 0.8715, sorry, 0.8785, and actually reach as low as the 0.8715. Okay, let's move now to the Aussie. Despite the efforts of AUD/USD to actually break above the R1, 0.6490, see how they have failed, and the pair remains in sideways motion between the R1, 0.6490, and the S1, 0.6380. At this point, it would be interesting to note that we already had the first manufacturing PMI from China, which was better than expected, but still noted another contraction of economic activity. Hence, I think the main takeaway here is that Chinese factories are still struggling. And that may somewhat weigh on those, given the close Australian-Chinese economic ties. I would be noting also the release of the Kaohsiung manufacturing PMI figure for August tomorrow. It's going to be interesting to see whether the big picture remains the same or if the Kaohsiung indicator is going to be showing us something different. I wouldn't expect much. Most probably the struggle goes on. Nevertheless, the capex was better than expected for Q2 in Australia. That provided some slight support, but the gained ground was quickly left over once again as the pair rolled below the R1, 0.6490 once again. Sideways motion bias is maintained, given also the RSI indicator, which has been dropping, aiming for the reading of 50. Should the bulls take over, we may see the price action breaking the R1, 0.6490, and clearly start aiming for the R2, 0.6610. Mind you, let's not forget RBA's interest rate decision next week, which is going to be of quite an interest. Should the bears take over, we may see AUD/USD dropping, breaking the S1, 0.6380, and start aiming for the S2, 0.6285. And let's have a look at USD CAD. Let's zoom out a little bit. Readjusting the labels. So we have better visualization once again. The S1 has been broken and has to be turned into a resistance line. Let's widen this a little bit. Now there's a clear peak here, but for me it's not sufficient. So a clear true here, but for me it's not sufficient. I would require something a little bit lower, and I would be marking this level. You can see how it had also provided support once, twice, 3 times, and resistance back here. Okay, I'm keeping that, and it would be the ultimate support line in green, namely the 1.3265 support level. Locking it in. Let's also readjust, correct if you prefer, the labels. Starting with the R3, which is being placed at 1.38, the R2 at 1.3645, the R1 at 1.3565, sorry, 1.3560, the S1 at 1.3485, the S2 at 1.3385, and the S3 at 1.3265. Yep. Locking it in. That's it. So the upward motion of USD-CAD has been broken. That's since yesterday. We tend to maintain a bias for the sideways motion to prevail for the time being, given also the correction higher during the Asian and early European session today. Possibly, though, remain below the R1 1.3560 and above the 1.3485 S1. So that would describe the boundaries of the current sideways motion of USD-CAD currently. Should the bulls find it able to push the pair higher, I would expect the first signal to come after breaking, if the USD-CAD breaks the R1 1.3560, and the next possible stop for the bulls could be set at 1.3645. Maybe even 5 pips lower, nothing much. On the other hand, should the bears take over, I would expect the price action to drop, clearly break the S1 1.3585, and start aiming for the 1.3385. The RSI indicator is below the reading of 50, but it's nearing it, and that may imply that the bearish sentiment is slowly fading away here. One more indication for a possible sideways motion. Nevertheless, let's not forget that the pair may be affected more heavily today and tomorrow in the American sessions, as today we get a number of financial data from both Canada and the US. And tomorrow we highlight the release of the US employment report for August, while from Canada we're getting the GDP rate. So it's going to be an interesting pair to watch over today and tomorrow in the American session. Let's not also forget the BOC's interest rate decision next week. And cat traders may be keeping also an eye out for prices. So that should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.
We will look at debt-based investments and their difference from stocks. While as a trader you can trade stocks via CFDs without actually owning the underlying instrument, an investor will invest in the actual stock and own it. Most investors focus on investments that aim to increase wealth and to help them reach their financial goals like a comfortable retirement or the ability to pay for their children's education. When investors buy stocks, they purchase assets whose value is expected to increase and provide a nice return when sold. Investing in stocks also allows the owner to access a portion of the company's profits through dividends, share buybacks, or reinvestment, which helps to grow the company's and the stock's value. The stock market offers volatile returns over short periods of time, such as 5 years or less, but higher returns over decades-long time periods. Debt investment can be government, corporate, and municipal bonds, as well as real estate investments, peer-to-peer lending, and personal loans such as mortgages. With a debt-based investment, you do not own an asset or a company, but instead you lend money to an individual, corporation, or government in exchange for a fixed income in return. Such investments typically offer a lower return than stocks, but are considered to be more consistent. There is some risk involved, as you might not be able to receive the funds you have loaned, and it's so important to choose your investments wisely. While they might be less risky and volatile than equity investments, they offer lower returns. The bond and mortgage market has fewer price changes than stocks. Equity investments, such as stocks, are securities that allow investors to have a claim on the earnings and assets of the corporation. Common stock trader on popular stock exchanges is the most popular equity investment. The stock market is very volatile, with rapid changes in share values. These fluctuations are usually related to political, social, or other issues in the home country of the corporation. Equity investments are famous for high risks and potentially higher rewards. It is traditionally recommended to investors that they hold both equities and debt-based investment for better diversification of their portfolio. Debt-based investments perform differently than stocks and increase during years of large stock declines. An individual's exact allocation is dependent on the investor goals, risk preferences, and investment time horizon. When it comes to trading, it is important to understand that all trading comes with risk. Depending on your trading goals, you can choose what suits you the best. You can always tailor your trading actions to match your objectives and risk tolerance. Thank you for watching.
First, today we're going to be talking about preparing for earnings season. We're just going to go through a couple of tips and what this means for you as a trader. Okay, before we get started, as per usual, we're just going to go through the risk warning and disclaimer. So our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. So our disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, hi everyone, I'm Melanie, and I will be your speaker for today. I'm an investment analyst from the company Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019, 2020, and 2021. Okay, so here is our agenda for today. Firstly, we'll briefly talk about what exactly US earnings season is and what we should do to or what specifically we should watch out for, and how we can trade them. And we'll also go through some risk management strategies as well. Okay, so what is the US earnings season? The earnings season is the period of time during which a large number of publicly traded companies release their quarterly earning reports. So in general, each earnings season begins 1 or 2 weeks after the last month of each quarter. So December, March, June, and September. So for what does this mean for investors? So this is basically a very active time in the market, as participants such as yourselves, analysts, traders, investors, review the earnings reports, which may affect their positions on or in a company. You can often see a lot of movement in the shares of companies releasing reports as the market reacts to the new data. So it is not unheard of to see shares jump 20% or more, or to see them fall by the same amount. So it's also a highly active time for the financial news media, such as CNBC and the Wall Street Journal. There is extensive media coverage of the major earnings releases, from a general recap of the earnings to a report on whether the companies missed, met, or beat analyst expectations. So some traders look forward to the earnings season, as it can be a period where they confirm the positions they have placed. For example, shorting a stock before earnings and watching the price drop can be beneficial, as the psychological drop will usually trigger a sell-off. Conversely, a ramping up in production or revenue could result in a swift upward trajectory or stock price. So other investors sit out the season entirely, as there are too many human factors at play. So there's just some things for you to take note of as well. So for this year, July 2023, the second quarter earnings season has begun in earnest during the second full week of July, led by banking giants JP Morgan, Chase, Wells Fargo, and Citigroup. Analysts at US financial data group FactSet estimate an earnings decline of negative 7.1% for the S&P 500 companies, which will mark the largest earnings decline reported by the index since the second quarter of 2020. Okay, so this is the update or the current situation that we are facing. What exactly can you do to, as we await more earnings report releases? So these are just 3 tips or 3 things that you can keep a lookout for. So firstly would be the performance of bellwether stocks. Second, earnings recession, as well as thirdly, the earnings and stock index weighting. So there are a number of factors that you can look out for in companies' earnings reports, but traders should be the most mindful of performance of the largest bellwether stocks, as well as understand the significance of an earnings recession in a given stock, and grasp how a stock's earnings announcement might impact a relevant index depending on the weighting of the given security. So we might go and look into DXY as well later on, after we are done with our slides. Okay, so let's get into it. Firstly, we have performance of bellwether stocks. So some examples of bellwether stocks would be FedEx, which most of us are familiar with. It's a shipment company for consumers as well as businesses internationally. Next, Caterpillar is the world's largest heavy-duty machinery maker. It's viewed as bellwether given that it has a large exposure to construction, manufacturing, and agricultural industries, particularly in China. 3M gauge for the health of the manufacturing sector, as well as Apple, which we are all familiar with. So when analyzing company earnings, it's important to look out for these stocks similar to these, because it can be seen as a gauge of the performance of the macroeconomy. So while the status of a bellwether stock can change over time, the largest and most established companies are typically considered a bellwether stock. So these are the examples that we've given, but of course there are others as well. Okay, next we have, we should look out for the earnings recession. So what exactly is the earnings recession? It's basically categorized as 2 consecutive quarters of year-on-year declines in company profits. So it's important to note that while earnings are an important factor in the stock market returns over the long term, an earnings recession does not necessarily coincide with an economic recession. So the chart that I've included here from Thomson Reuters data stream shows that in the past 6 earnings recessions witnessed in the US, only 2 had coincided with an economic recession. So the blue circles that you see here show where there was an earnings recession without an economic recession, while the red circles represent where both earnings and economic recession occurred simultaneously. Okay, next we have the earnings and stock index weighting. So traders should understand that when trading earnings, certain stocks will have a greater impact on the wider index according to their index weighting. So the example that I have here is when trading the Dow Jones. Boeing releasing its earnings will be highly influential on the index, while Visa likely won't be as influential. Why? Because of its former's 9.49% weighting compared to the latter's 4.1%, which you can see in this table that I got from dailyfx.com. So this really highlights the importance of paying close attention to bellwether stocks and how they may impact a broader equity index. Okay, so how exactly are we going to trade using all of the information that we have? So we've simplified it into 3 simple steps. Firstly is to select a specific company to focus on, or set of companies. Secondly would be to do your research, and thirdly would be to formulate a trading strategy and follow it. So firstly, choose companies to focus on. This is pretty straightforward. It's advisable for traders to go for a small number of companies, perhaps stocks that you are already familiar with or trade already, and find the dates on which their earnings will be released. So large bellwether stocks are worth investigating whether one is trading them or not, as the impact of their results can impact wider industries as well. So when you're deciding on the stocks to go for, traders should understand that the relationship between an earnings result and subsequent price reaction is not always straightforward. So for example, if there are better than expected earnings, that normally indicates a bullish bias, but it does not always translate to immediate price gains, and the opposite holds true as well. So the example I have here from DailyFX as well is Walmart's strong earnings in the third quarter of 2013 or 2018. And this is failing to excite market participants. So while encouraging, a quarterly report is more than last quarter's results compared to expectations. So analysts are often much more concerned with the future expectations of the firm, as price is a forward-looking metric, with future earnings being calculated in current prices. So if we think about it that way, then it becomes much more reasonable when investors like yourselves perhaps shy away from a stock with strong results for the past quarter, but an abysmal outlook for the future. So weaker outlook can seriously undercut a stock's current valuation as well, regardless of past performance. Okay. Next, we have doing your research. So this ties nicely with our fundamentals analysis as well. So doing your stock research properly will involve looking at estimated earnings for your chosen stock. It also involves comparing these earnings with the analyst's expectations. Traders should also make sure that they look at historical figures to get a feel for how the market has responded to releases in the past. So while earnings season is typically thought of in terms of what the results mean for a single stock, the season as a whole can also offer important takeaways. So one such takeaway is information is offered on a company-specific basis, but common themes can ring true throughout. So one such headwind would be our recent coronavirus, or perhaps geopolitical tension in specific areas. So these can combine to form a wave of worries across all sectors or specific sectors, if the impact is big enough. So traders should investigate how such headwinds impact on one sector or stock compared to others. So another example would be perhaps many industries suffered greatly during our pandemic, but March 2020 saw Greece-based tanker vessel operator Topships Inc. experience a surge in product demand in areas such as cleaning supplies as well as paper products, leading to increased shipping requirements. So this in turn created higher trading volume and volatility. Okay. Lastly, formulating a trading strategy and following it. So formulating a trading strategy for earnings season should include a methodology for entry and exits, profit goals, time spent trading, and a risk management plan. Trading earnings reports is typically difficult and risky. So for some, trading around the event may not suit their risk profile. And so any position taken should be adequately hedged and definitely include a stop loss. So with that said, volatility can of course also create unique circumstances. So it can also provide opportunities for a few specific strategies as well. Okay, when formulating a strategy for earnings season, traders should be aware that quarterly earnings are capable of seriously uprooting an ongoing price trend due to their relative infrequency and importance. So this often causes traders to position for severe price swings, evidenced by heightened implied volatility. So we'll go through a couple of stop loss strategies or risk management strategies that you can implement into your trading strategy as well. And these are not specific to only earnings season or stocks, but of course, for Forex or your commodities as well. Okay, so firstly, we have the most basic, which is proper stop loss and take profit placement. So proper stop loss and take profit placement is crucial to ensure that you maximize your wins and minimize your losses. So for stop loss, it should be placed beyond the resistance area, while take profit should be placed before. Okay, here is just an example for you to look at as well. Okay. Here we have trade management with confluence. The confluence that we're talking about in this case is referring to Fibonacci confluence. But if you have a couple of support levels lining up, resistance levels, those are considered confluence as well. So firstly, stop loss should be placed beyond, as we saw earlier. And this basically means that you should always put your stop loss beyond a key Fibonacci confluence area. So the reason for this is because more often than not, price is attracted to such strong areas of Fibonacci confluence. And if your stop loss is right before instead of beyond it, you will most likely get stopped out before the market reverses. Okay, as for take profit, we always recommend to place it before a key confluence area. And the reason for that is because when price reaches a confluence area, there's a high chance that it will not be able to go beyond it. And instead of reaching your profit target, it reverses back to your entry instead. Or even worse, your stop loss. This is also one of the reasons why people complain that the market is being manipulated, because they miss their take profit by 1 or 2 pips. Okay, now we'll take a look at a couple of dynamic take profit placement examples, just to show you guys a couple of real life price examples. Okay, so here we have a negative 27.2% Fibonacci extension that lines up nicely with the 127.2% Fibonacci extension. Okay, you can see this over here at this blue highlighted area. So that's where we've placed our take profit. And as for our entry, we've placed it at this overlap area. So an overlap resistance in this case basically means that you have a swing low that lines up nicely with a swing high. Okay, so our entry is a pretty strong level since price has tested it many times before. And then our stop loss is just at this swing low here. So the take profit, we've placed it above the confluence area. And you can see when price moved up, okay, this is the before, right? We're expecting price to bounce off of the entry and hit towards our take profit. But in this case, we placed our take profit before the confluence area. And you can see it reversed off and it missed our take profit by a couple of pips. Okay, it did exactly what we expected it to do, but it reversed off because of the strong resistance area over here. So in this example, we place the take profit under it instead, or below the confluence area, and we can see price hits our take profit nicely before reversing back down to our entry. Okay, so that's just one example of a risk management strategy. The next example we're going to be talking about is break even. So just really quickly, because this is not a risk management webinar, but we're just giving you some examples of how you can implement this into your trading strategy for earnings season as well. So break even is a level where you are in profit and recognize that there's a risk of a reversal back to your entry. So it's basically you saying, if I'm right, price should go all the way to my target, but if it goes back to entry and you are wrong, then you should get out. So firstly, we have our entry. So our entry is over here at this blue dotted line right over here. So we go in for a buy at this double swing high resistance. So it goes up and then it fluctuates a little bit. And then instead of shooting up towards our take profit, which is represented by this green area here, instead of going all the way up, it actually reversed down. So when it reversed down, this specific area here at this swing high, level is our break even. And it's our break even because we see price reverse back down. So we panic and then we put our stop loss originally is here, but because it reversed over here, we want to place our stop loss over here instead. Okay, and then it reversed off, it hit it back up, and we think maybe there's a possibility that price is gonna hit our take profit here, but it doesn't. It reverses down, and you get stopped out here. But it's fine because even though price has, or rather price, you've been stopped out, but you still you didn't make a loss in this case. Okay, I hope that was clear what exactly a break even is. Okay, next example we want to talk about really briefly is idea invalidation. So idea invalidation is usually placed before your stop loss. It's the level at which you basically admit, I'm wrong, let me get out ASAP. So when this level is reached, your take profit is moved to your entry, giving you a small chance to get out at break even. So in this example, once again, we are entering from here at this level here with the two swing highs, and then price reverses down and we expect price to continue downwards to hit our take profit, but it doesn't, and it reverses and hits back up. So it hits back up and it even surpasses our entry, continues upwards, and then our original stop loss line was here, but instead of moving our stop loss in this case, we add an we move our take profit instead. Okay, so what we mean by this level, the purple level, is our idea invalidation level, is that it's basically at this point where we realize that we want to get out of the trade. Okay, so it reverses off and it hits our take profit nicely. Okay, but if we didn't modify our take profit and we just left it over here, it would have reversed and shot back up and hit our stop loss instead. So we got out here at break even before price rose further and stopped us out. So idea invalidation involves moving the take profit, whereas break even, as we saw earlier, involves moving our stop loss line. Okay, I hope that was clear. We go more in depth into the different kinds of risk management techniques in our risk management webinar series. So you can stay tuned for that if you've missed those before. But yeah, this is just a brief run through of some of the techniques that we use. Okay, so just a bonus slide, some tips for you to take note of is to firstly know the expected results. So keep up to date with the releases. Secondly, stay alert to surprise announcements from the respective companies. Thirdly, be aware of spillover effects between stocks, since especially for stocks within the same industry, a release of one stock can definitely impact the earnings report of another. Next, consider volatility over the bearing of an expected move. So you should definitely be aware of what the expected number is, as we mentioned earlier, and then be careful, or rather take note of whatever volatility that follows the release of the earnings reports. Okay, and that is all for our slides. Now we're just gonna get into some of the setups for this week. So we have a request for Brent oil. I think we'll look at DXY as well, since we're talking about the US earnings report as well. Okay. So we'll do Brent oil first. And if there are any other request, let me know in the chat. Okay. Okay, let me just check to see if you guys can see my chart. Okay, all good. Okay, let's get into it. So as per usual, we want to look at the higher time frames first, just so we get an idea of where prices are headed. So the general direction is pretty bearish on a weekly time frame, and on our daily time frame as well. Okay, let me see if we have a trend channel on our. Okay, price is moving in this, or rather, price has broken out of this descending trend channel on our daily time frame. Okay, so this gives us a bit of a bullish bias. So let's take a look at this on our 4-hour time frame. Okay, it's pretty bullish as well on the 4-hour time frame. Okay, no trend channel. Let's see if we have a trend line. Okay, yeah. So remember, for a valid trend line, there has to be minimum 3 touches on the trend line. In this case, we definitely have 3. Okay, so let's get into our support and resistance levels. Okay, so for my first resistance, I'm going to place it at the closest swing high to where price is currently at, and I'm going to try and pull it all the way back as far as I can without cutting too many candlesticks. Okay. And then first support level will be over here. Second support maybe here. And second resistance here. Okay, now that we have these levels, I'm going to go in with some Fibonacci levels. So for a Fibonacci retracement, which is what I'm looking for here, we use these 5 levels. So I can see my 78.6 lines up nicely with my first resistance. Yeah, that's all. Next, I'm looking for a projection. So for Fibonacci projection, we use these 3 levels. And I can see my 100% lines up nicely with my second support. Okay, my 61.8 also lines up with my first support. And I'm looking for another retracement here. Okay, and my 38.2 lines up with my first support as well. Okay. Okay, I'm just looking for a extension here. Okay, and my 16, so for Fibonacci extension, we use these 2 levels, 161.8 and 127.2. And my 161.8 lines up with my first resistance. So you can see that I already have this huge area of resistance here because I have so many levels that line up. Okay, another thing, if you guys are wondering what exactly is a Fibonacci extension, it's basically when we call it the Nike tick retracement. So when you have a shape like this, or perhaps if it's inverted, it will be like that. Once it has retraced 100% of the head, then you can use this method, and it's to project where prices are going to bounce off of. So it bounced off of the 161.8 as we can see here. And earlier I used the 127 as well, but it was over here, so it didn't have any effect. Okay, that's for extension. Let's see if we have anything else. Okay, okay, no. Okay, that's all the Fibonacci levels that we have here. So we can see this huge confluence area here is what is pushing price downwards, but it's not likely to, or rather we don't see any signs of price breaking out of this ascending trend line. So even though it is a bit bearish over here, we can expect it to head towards maybe this our first support level here, but probably no further than that. Why? Because of this ascending trend line, but also because we have the 61.8 and also the 38.2 Fibonacci retracement. Okay, so now let's pull in some indicators to support this. So Ichimoku price is moving above the Ichimoku cloud, giving us a bullish bias. MACD is also giving us a bullish. Okay, I accidentally clicked on the SMA, but it does look like price is breaking out of it. So it's breaking out of our moving average, and it appears to be moving below it instead. So it's giving us a bit of a bearish bias. Okay, and then over here we have a bit of a bearish divergence as well. So price is making a higher high on our price chart, and price is making a little bit of a lower high on our RSI. Okay, so I'm gonna go ahead and remove Ichimoku and MACD because it doesn't support our analysis. Okay, yeah, I'll definitely look into gold as well. Okay, so here is our analysis for Brent. So we're expected to drop from the first resistance towards our first support, but probably no more than that because of the confluence and because of the trend line. Okay, next, let's take a look at gold. Okay, same thing, we're gonna look at the weekly time frame first. Prices are pretty okay. It looks like prices are headed upwards, quite bullish over here. We have 3 swing highs, but apart from that, nothing else. Okay, here's our daily time frame. Okay, we have an ascending trend line here. Okay, let's see. So pretty bullish on both the weekly as well as the daily time frames. Okay, let's take a look at the 4 hours as well. It looks like prices just broke out of our descending trend channel on the 4-hour time frame. Let's see if we have a channel here as well. Okay, no. Okay. So we don't have any channels or trend lines, so we'll just go ahead and start off with our support and resistance levels. So here's my first resistance, closest swing high to where price is currently at, and then swing support level is at the closest swing low. Okay, I'm just gonna highlight this level as my intermediate support level. Why? Because we have seen that price has tested this level many times. Okay. Yeah. Okay. So we're likely seeing a buy towards our first resistance over here. Okay, let's see if we have any Fibonacci levels. Okay, are my 23.6 and 38.2 line up nicely? And Okay, my 78.6 Fibonacci projection also lines up with my first resistance. Okay, my 50% lines up. Okay, what else? Okay, I think that's it. So now that we have these levels, let's go in and look at some indicators. Okay. Ichimoku isn't really telling us anything now because it's moving within a cloud. But it does look like it's breaking out and moving above, but only when it's moving above, then we can confirm that it's bullish. As of right now, MACD is also bullish. RSI. Okay, we have another divergence over here. Okay, price has made a higher low. Whereas on our RSI, it's made a lower low. So we could be seeing price continue to drop because this is a bearish divergence here. Okay, but on our SMA, it's moving above the line as well. Okay, so in this case, we can probably expect price to continue to go up towards our first resistance here. Because of all the upward pressure we've seen on the daily and weekly timeframes that prices are pretty bullish, and we want to trade. We normally like to follow the general direction of price. And on our SMA, we can see price is bullish on our MACD as well. But our RSI doesn't support our analysis, so I'll just remove that. And then we can also keep an eye out on our Ichimoku indicator as well, because it does look like price is breaking out over here. Okay, and then with all of this support area here with the multiple swing highs, the 23.6, we are not expecting prices to continue to drop to this level. It's likely to continue to push it up towards our first resistance. And our first resistance also is a pretty significant level with all the swing highs as well as the retracement level. So it's likely to attract price towards that area. Okay, that's all for gold. I think we have time for maybe one more chart. So if there are any requests, feel free to let me know in the chat. You're fine. Okay, sure. Okay, weekly time frame, it's pretty bullish, bearish, as you can see. Okay, daily time frame, pretty bearish as well. Okay, on our 4-hour time frame, definitely bearish as well. Okay, let's go ahead and add some support levels. Okay, now let's see if we have any channels. Okay, I don't think so. Trend lines, maybe. Okay. So we have our first support. Let's go in with another level. I have a resistance here, first resistance. Okay, it's a bit hard to analyze on this chart because there are no previous levels for us to take note of. So we're just gonna jump right into our Fibonacci levels. Okay, so earlier I mentioned Fibonacci extension. So we're going to take a look at okay, I have my first resistance here. Okay, my projection level lines up nicely, as well as my 100%. Okay, I'll maybe get rid of this intermediate support. So I remove my 127 as well. Okay, let's see if we have any other levels. Okay, I think this level over here will be my second resistance. Okay, in line with the 78.6 and also the swing low over here. Okay, I'm gonna add my first support over here. And then this will be my second support, just because it's a bit closer to where price is currently at. Okay, now let's go in with some indicators. I'm pretty sure everything will be bearish. So we have price moving below the Ichimoku cloud, bearish and bearish as well. Let's take a look at RSI. Okay, all pretty bearish as well. Okay, So we can expect price to continue moving downwards towards our first support because of all of the downward pressure from this descending trend line. Excuse me, from this let me highlight it, this resistance area, because of the confluence area as well, 61.8 Fibonacci projection, and also the 161.8 Fibonacci extension. So we have that, and also our indicators all giving us very bearish signals, so we can expect it to continue to drop to our first support. Okay, that's all the time I have for today. I hope you guys found it helpful and learned something today, and I will see you guys next week. Thank you guys. Have a great rest of your week. Bye. Thanks, Fan. Thanks, Yuhao. Bye. See you guys next week.